Hi, my name's Denise Vansant, and I am the broker in charge here at Vansant Realty Group in Myrtle Beach, South Carolina. And today I am here with Ed Bocchino, the branch lending manager at Revolution Mortgage here in the Myrtle Beach area. You know, Ed, I get a lot of questions from my buyers about financing options. So I thought this would be a great topic for us to talk about today on our podcast.
Yeah, first off, thank you so much, Denise, for having me here today. Super exciting. I love the lights and the cameras and all of that stuff. So this is great, and I really appreciate the invitation.
Oh, well, I couldn't think of anyone better to ask.
Oh, thank you.
So let's talk about some popular financing options that are out there for, let's start with first-time home buyers. Mm-hmm. Here in South Carolina, we had the SC housing program that I get quite a few questions about from first-time home buyers. And it's really helpful for them to get into a home when they've never purchased before, especially those types of buyers. So let's hear about some of those options.
Yeah, so a lot of states nationally have, specific state-specific first-time home buyer programs. Here it's called SC Housing or South Carolina State Housing Programs. And it definitely does offer some assistance for folks, first-time home buyers looking to purchase, whether it's down payment assistance or it's assistance towards closing costs. It could offer upwards of $8,000 to $12,000 depending on the product and the qualifications. Still needs to be, the client there is a level of qualification that they need to go through, of course, but if all the guidelines are met, we have some in our pipeline right now, right, helping folks out, getting some money towards closing costs, and it's great product for first-time home buyers, gives them a little extra money, again, whether it's towards closing costs, down payment. We also have a program that we've just rolled out in-house in conjunction with the state housing program. Our in-house program is an FHA DPA. DPA stands for Down Payment Assistance product. So we're actually financing as a company the 3.5% portion, which would normally be a down payment for someone buying an FHA, a home with FHA financing. Mm-hmm. We're financing the second mortgage ourselves. So when they would normally put down 3.5%, now they really don't have to put anything down if they qualify. So it's 100% financing. And the difference between our in-house DPA program and state housing is ours primarily follows the guidelines of FHA versus the guidelines of state housing. So whether it's debt to income ratio, how much money they bring in, versus how much they're putting out, state housing has a lower or a tighter standard on that than FHA does. So on top of having state housing for first-time home buyers, we also rolled out our FHA DPA program, which is going to have a little bit more flexibility for them as well and offer a little bit more money versus being capped at roughly $8,000 to $10,000 through the state housing. Ours is just capped at whatever that 3.5% is of the purchase price. They could be buying a home for $400,000. And that 3.5% down payment is now a second lien that we hold in-house to finance. So they're essentially at 100% financing.
Mm-hmm. Well,
it's a lot. It's a lot of stuff going on. But
it certainly is. And, that is a program that just a whole lot of people don't know about. And I don't think a whole lot of lenders offer.
And we're the only ones in South Carolina that's offering that. There's only 13 lenders overall nationally that have that FHA in-house DPA program. So we're excited about it.
No, and it really is, and it's important to know that different lenders offer different products, and it does matter what lender you're using. You don't want to use a generic lender.
Yeah, and with any product, whether it's a product for first-time home buyers, whether it's a product for investors, I'm sure we'll chat a little bit about DSCR loans and all these acronyms and things that we throw out there. But it may only be used 1 or 2% of the time, as a product. But if you don't have it, that person at that moment doesn't have that opportunity, right, to purchase something because there's nothing that, kind of fits that mold. Everyone's situation is different, whether they're self-employed, whether it's a bank statement loan, a 1099 loan, a full income verification loan. I mean, there's so many different pathways that someone can take on the way to purchasing a home. We try to fill every gap that we can from a product standpoint and make sure we have something for everybody.
For sure. And one of the things about living in or purchasing in Horry County or Georgetown County through the SC housing program is that everyone is a first-time home buyer as long as you've sold your primary home before you move into your next home. Mm-hmm. Does that DPA program that you have still work with that?
Yeah, it's FHA. Okay. So it's, you could have owned 15 houses the last 2 years and you're buying a new primary, and you can use FHA for that new primary.
Yeah, and that's an awesome program for people to know about, and I think if we get the word out there, more people would take advantage of that particular type of lending.
And like I say to my business partners, all my agent partners, let us be the filter. Mm-hmm. And a lot of times home buyers, especially first-time home buyers, right? They don't know sometimes what they're asking, right?
Exactly.
And they're trying to get information from as many people, rightfully so, as they possibly can, mm-hmm. And regardless of what someone says, this is what we do, right? We know the guidelines, we know the products. Let us be the filter. Let us chat with them. If there's a place to find a home for them, from a guideline standpoint or product standpoint to get them into a home, we'll be the ones that'll make that determination.
Yeah. So, to a buyer, I always say to my buyers, your realtor really matters. They have to be educated in financing and what options are available out there. They have to know the basics about the loan programs. Mm-hmm. And some of us do and some of us don't. You have to know the lenders that you're working with and what products they offer. So that's just something I really wanted to point out. To work with I try to work with lenders that offer all the products that are very specific to what my clients are looking for, whether it be investment products, first-time home buyer products, conventional, FHA loans. They're all different products. And we need to work with lenders that are knowledgeable and work with all those products.
Yeah, and thanks. And to your point, right, and what makes you, success is relative, but in my mind, very successful, right, in what you do for your clients, is having enough knowledge that you need in the areas to make sure you're getting them to the right spot.
Exactly.
Right. And I always say, there's a lot of things about real estate I don't know, and I'm not ever going to pretend to know, right? And I stay in my lane, for lack of a better way of putting it. Mm-hmm. But these buyers are, and this is what I love about the agents and the way that you do your business down here versus some other areas I've seen nationally where they basically write a contract and it moves on to the attorneys, right? And they kind of take care of everything. Here, the agents are doing everything, right, for the most part. But they're looking for guidance. The buyers are looking for guidance, right? Mm-hmm. So to have enough knowledge, and I know you and I speak often, right? What do we have for this product? What do we have for that? I think it's great because to have enough knowledge to, give them confidence that they're heading down the right path is incredible. And that's, that's something that everyone should be looking to do that's in the industry.
And while we're talking about this product, it makes me think about other products that are available for first responders and those types of products for physicians and nurses and things. How about a quick go over of those types of products?
Yeah, there's, again, let us be the filter, right? There's definitely qualifications, earning qualifications, credit score qualifications, debt ratio qualifications, but as a whole across the board, you have Palmetto Hero program that offers money towards first responders for purchasing a home. There are doctor loans that are available out there with super reduced down payment, requirements. If you can think about it, there's a product that generally exists out there. Now, some of them are, they're state funded, right? So they may have funds now, but they may run out of funds, right, for that product, like the Palmetto Heroes, right? They turned that on, a couple of weeks ago, or something like that. And generally by the end of May, coming into June, they start to run out of, funds. So, you got to kind of act quick to get into that. But that's where we came up with that in-house DPA program, right? Mm-hmm. Because that's something that lasts forever, right? As long as we continue on with the product. So don't have to worry about running out of funds. It's our funds.
Correct. Talking about the first-time home buyers makes me think of another question I get quite often, because first-time home buyers need so much guidance often, pre-approval. Mm-hmm. And the importance of getting a pre-approval. A lot of my first-time buyers will come and say, we decided it's time, we're ready to buy a house, we want to move on, get out of this rental we're in, and start turning our money into wealth, building wealth through our first home purchase. And I'll say, okay, let's talk about that. And are you working with a lender already? And if so, have you gotten a pre-approval yet? Tell us about why a pre-approval is so important.
Yeah, and pre-approval is like the end result. It's the discovery piece that I think is the important journey that a first-time home buyer should go down. And not just a first-time home buyer, anyone looking to purchase a home. So whether it's your first home, whether it's your fifth home, whether you're buying a vacation or a second home, or whether you're buying an investment property, getting pre-positioned and understanding everything out of the gate is super critical. What you may have qualified for, 5 years ago, saying it's a second home buyer, we'll get back to the first time home buyers, someone buying another home, they've owned 3 other homes before, whatever, doesn't mean that the guidelines are the same today as they were 5 years ago. Right. Doesn't mean that your income, you may feel, yeah, well, we're doing great, we got plenty of income, and yeah, oh, I'm sorry, but you're self-employed, right? And you write off 90% of your income, and your taxable income goes from this down to that, and that's what we use is taxable income to qualify. And though they feel like they should definitely qualify from a full income verification standpoint, they just simply don't. Now, it doesn't mean there isn't an option for them, but understanding where they are prior to getting involved and going out and getting excited about a home that you're looking at, or this or that, the other thing, without knowing everything else, could be very detrimental, and just disappointing, really. It can likely still, get to the end, but it may not be what you thought it was out of the gate. So getting pre-positioned, working towards a pre-approval, not just for the piece of paper that says I have a pre-approval, but for the understanding that you've gotten, the education you've gotten through that process to say, here's where I'm comfortable at, right? For first-time home buyers, for any home buyer, but let's say first-time home buyers, it's supposed to be exciting.
Oh, yeah.
It's supposed to be exciting. It's supposed to be fun, right? In 32 years of doing this business, guidelines haven't been any tighter. I mean, they're about as tight as it gets, right?
Yeah.
Thankfully, we have a system and a process in how we navigate folks from contract to close, right? Very communicative, very transparent, very efficient. However, get all the heavy lifting done out of from out of the gate, right?
For sure.
So when you do start to go search and look for homes, we know we're within budget. We know we qualify. We know that we're going to close. Once we put a contract in and it gets accepted, now let's pick out the furniture. Let's pick out whatever. Let's have fun with it. Let the kids go through and see what room they want to claim as their own. Right? Instead of, well, now, is this really going to happen? Get that, is this really going to happen out of the way before you even start looking for a home? So the pre-positioning, the education, the pre-approval piece, I can't stress how important it is. And I think, people kind of get pushed back a little bit when you say, did you get pre-approved? Right? It's like, ooh, aggressive.
Yeah.
Right? Oh, what do you mean pre-approved? What does that mean? Right? I call it pre-positioning because that's what it's really all about, right? And it's just conversation. There's a lot of great mortgage folks, here throughout the area as well. I know a lot of them. We just ask questions, right? We're just working to put you in the best position possible and make sure that you understand, what it takes to purchase a home, or what strategy we have to, deploy to get there. So don't let the word pre-approval push you back a little bit as someone that's maybe looking to buy a home. It's 100% for your benefit. If you're serious about buying a home, that's what you need to do.
And another thing to think about that goes along with the pre-approval is once you're pre-approved, remember, I always try to tell my buyers, don't go out and make any big purchases.
Don't breathe. Don't breathe. Hold your breath.
Yes.
Right.
Until you sign the dotted line.
Until we are closed.
Your house is closed and it's yours.
Call us before you do something. And I do get that. Hey, I'm looking at this. I know we're in contract. I really, want to get this or do this. Can I do that? Can I do this? And I'll tell them, yes, you can, or no, don't do anything. But you're right. I mean, it's, we took a snapshot of everything on that day, right? And that's the way we want it. when we get to this day of closing, right? So no new cars, don't open up new accounts, that we don't need to open up. And again, doesn't mean you can't do it, just check with me first. But best practice, don't do anything. Don't do anything that's any different.
Exactly. You can buy that all that new furniture as soon as you close, but just hold off. You don't want to cause any detriment to the purchase of your new home.
Right, yeah, no doubt.
Yeah. Which you're making.
And don't quit your job.
Oh, yeah. Yeah, that's another one.
Don't quit your job.
That's kind
We've seen that. Oh, well, I didn't know. Well, yeah. Yeah, no, that's a challenge. Yeah, please don't quit your job.
Important one. But you're making me think about credit scores now. That's another important question we get, big question, credit scores. FHA versus conventional loans. Let's talk about that real quick.
First off, you're asking me a lot of questions here, Denise. Thankfully, I think I have all the answers.
You're the man.
So conventional is pretty simple, 620. Anything less than 620, that's the floor for conventional financing, whether it's Fannie Mae or Freddie Mac. 620 is the floor. Credit scores from a mortgage standpoint will go up to 850. But generally speaking, when your credit score is above 740 or higher, you're basically getting the best pricing that you can qualify for, right? That you can get from a full income verified standpoint, from any standpoint in financing. Conventional financing is awesome generally because there's a lot of, variables involved in whether we go FHA, we go VA, we go, if qualified, we go conventional. But usually, 680-ish to 700, 680 plus is sort of that conventional financing window that we would look at. If we're below 680, we'll then start looking, really comparing FHA to conventional. If we're below 60, we're going FHA. FHA just caters to a lower credit score, and it's not that the credit may be bad, right? There could have had some history stuff. They could have gone through a divorce. They could have gone through some life-changing event that put them in the position. I mean, there's a lot of reasons why, and they're just working on rebuilding credit, and maybe we're just not there yet, right? And FHA is a great product that caters specifically to folks, with those situations. An FHA score will go down to 580.
Okay.
Now you'll see advertising of non-QM brokers or investors that may go below that, right? But you're going to pay the price, and I would work on getting my credit improved before I would go down a path of an investor FHA product that may cater to people down to 500 at whatever incredible double-digit interest rate and costs, and it's ridiculous to even put them out there, but
yeah. Some of the other types of legend, you'd made me think of a situation that I had recently that I was talking with you about. I had a buyer who was self-employed, and he did not have the appropriate qualifications to actually get a conventional loan. So we went out looking for an investor loan. So some of the investor products that are out there and how they work, especially for self-employed people that are out there. Let's talk about that for a few minutes.
Yeah, sure. So self-employed, let's write off as much as we can, right? We have our income, we have all of our expenses, and we try to write them off, right? Just to benefit from a tax standpoint. Not that anyone's doing anything wrong, but the tax laws are there to help you, right? Which is great. But they could just say, for instance, drive in $200,000 in top line income, but after all their write-offs, maybe they show $60,000, right? But we're looking to buy a $500,000 home and have a $350,000 mortgage, and $5,000 a month is just not going to carry it, right? So there is a whole world out there, right, of investors or broker loans, and they cater exactly to those situations. So where conventional financing is going to go off of taxable income, basically for the most part, these investors have products available for bank statement loans. So I do a bunch of bank statement loans. right? So that is just based on cash flow coming through the bank statement. So you have your business bank statements or your personal, one of the two, not commingled, right? Because some people have their self-employment and they run it only through a personal account, right? They don't have a business account. That's allowed. But whether it's a 12-month or 24-month bank statement program, we look at what the cash flow is. It gets analyzed, and that's the cash flow. That's the number we use for income. I had one person that's closing, I don't know, an hour and a half ago, actually, self-employed, local here, and she has a lot of stuff written off on her income taxes. We did the cash flow analysis on her bank statements. I was able to use like $42,000 a month generated in income. Right, her debt ratio was close to 0. And we qualified, and she bought her home, and she closed this afternoon. So for self-employed, we have bank statement loans. We also have 1099 loans, right, where all you have to have is a 1099. We use up to 90% of the 1099 for income. And look, there's other little guidelines in there in between, but there's a whole world that caters towards self-employed borrowers. And again, you'll hear me say this often, let us be the filter.
Yes.
Right? Just get them into, whether it's me or, whomever, let us be the filter, and we'll see if there's a spot for them.
Yes. I've been hearing in the news so much about Biden's new regulations for mortgage rates on buyers. And a lot of us just don't understand what that is. And they think there's just a lot of questions about it. So let's talk about that for a while.
Great. I've only been asked this 837 times in the last week.
This is now 838.
838, perfect. So here's the truth of the matter. They're called loan level price adjusters, right? And they're in effect for absolutely everything inside of a loan. What the debt ratio is, what the loan to value is, how much towards the purchase of how much you're putting down towards the purchase, right? How much you're lending towards the value of the home. What credit scores are. Is it a second home? Is it an investment property, right? I mean, there's so many things that make up what's called loan level price adjusters, right? But the truth of the matter is, they've always existed. They've always existed, right? The fact that they hit the news waves a couple of weeks ago, frankly, I can't pretend I would know. Well, I could pretend I would know why, but people highlight things to try to for their own agenda, right? And it got a lot of people upset because I have folks that have great credit, and they're saying, "Well, geez, how come someone with lower credit than I have is actually getting a better interest rate than I'm getting?" And that's just 100% untrue. Yeah. Look, I wish everyone could get an incredible interest rate, right? But things are priced for risk, right? So what is true is this. If you have great credit, you get a better interest rate than someone that doesn't. It's that simple, right? Regardless of what you see or what you hear in the news in regard to this, adjustments are made every year to these loan level price adjusters. I think they're just being a little sensationalized based on the timing of where we are coming into elections, whatever the case may be. Right, wrong, or indifferent, they've always been there. They've always existed. They just happen to hit the news waves the last couple of weeks, and they've never hit them ever before. No one's ever questioned it. So I would, look, it's something no one can control. Yeah. Right? What we can control is to have the best credit score that we possibly can. Right. And the better the score, the better the interest rate. That's just the bottom line.
Yeah. And so if you're a buyer and you've been looking to buy, shouldn't let this scare you. It's really not going to impact you much.
Yeah, I mean, it's minimal. Again, no one's ever talked about it any other year, which is amazing. I've been in this business for 32 years. So there's always been loan level price adjusters. When the second home loan level price adjusters came out in 2022, April of 2022, that didn't get much news airwaves, and that was a heavy impact to second home buyers. And anyone that's looking to purchase a second home, we've spoken, right? But it's not stopping them, right? It just is what it is. It's things that are out of our control. There's circumstances that dictate whether you're buying a home or not buying a home, whether you're moving and it's a new primary, whether you can afford and you want a vacation home. I mean, geez, when you look at interest rates historically, with the last couple of years really being an anomaly, right? There was artificially, rates were down artificially, right? But when you look at the history of interest rates, good Lord, if we can land somewhere in the fives and ride that forever, that would be great.
That would be great.
That would be incredible,
I know a lot of people
right?
that would like that.
A lot of people. I speak to a lot of folks that say, 7%. They're like, that's okay. I mean, I remember when I was paying 12%. But, the people that have only kind of been in this market or got spoiled over the last couple of years, that were looking at 2.875, 3%, 3.25, 3.5. It's funny, I spoke with a client who's coming back into the market, and we closed around 4%, 4.125 back in like February of 2022. And we were talking, it's like, geez, that 4% doesn't seem very bad now. I said, yeah, but I remember our conversation in February, and you're like, 4%? I'm like, hey.
I wish it was 4%.
Yeah, I wish it was 4%. But look, I mean, if I say anything, yes, going from 3% to 6.5% or whatever, depending on qualifications, just throwing pricing comparison out there, that's a big difference. But it's where we are, and if you look at rates for the past 30, 40 years, I mean, we're in a great spot.
And I always like to remind people, once you make that real estate purchase, you're making an investment. Your property is going to gain equity. You're going to grow your wealth that way. Even though your interest rate might be a little bit higher, you're still not losing. It's still worth the investment.
Yeah, and we can never commit to anyone that their value is going to go up. You have, it's a roller coaster ride. But if you look at history, it's done nothing but go up.
Yeah.
Right? I mean, it goes up, it goes down, but the trend long term is always up. That's what makes real estate such a great investment. And I would never say to someone, well, you can buy today and you can refinance in a year and a half from now. The consensus is rates will slowly work their way down, right? They're not going to go down like they went up, right? They slowly work their way down, but we're a global economy. Anything can happen at any time, anywhere that can affect us here in the United States. So in the effort of managing expectations, and always erring on the side of caution, I'll never commit that this could happen or that could happen. But if you're comfortable with where you're at, then that's great. And and the other thing that we hear is folks saying, well, we'll wait for the rates to come down and then we'll look to buy. But people have got to remember, generally speaking, if rates come down, demand goes up. If demand goes up, prices go up. So where you might save, going from this rate to this rate, maybe you save $50 a month or $38 a month, right? And when you start putting it in perspective, that way it starts to register with people. It's not that big of a deal. The rate sounds like a big difference, but the payment's not significantly that much different. But am I going to pay $50 more a month, or am I going to pay $25,000 more for the property in a year? Exactly. Which one do you want?
Yeah,
right?
Exactly.
Because it's going to be one or the other, right? So, I think that's something that folks really need to consider when they're, and I hear it all the time from agents, well, they said that they want to wait for the rates to come down. Well, where do they think they're going? First off, no one knows that answer. Warren Buffett has no idea, right? The best economist in the world is right 50% of the time and wrong 50% of the time. So, bird in hand's worth two in the bush.
Exactly. And one thing we do know that if we're talking to renters, their rent is going to consistently go up every year. You can bet on that.
Yeah, generally speaking.
So, generally speaking. So, to purchase and lock in on that monthly mortgage rate is going to be better than looking at your rates go up and paying someone else's mortgage.
Well, and everyone's got a different situation. I speak to folks that are financing today, and they're going to pay the mortgage off in 3 years when they sell their home up north or wherever, and so it's short term, right? If it's a more long-term play, it's a great market right now to start asking sellers for seller concessions. Right, and let's do a life of loan buy down on the interest rate. So, if you're just per se, because I'm not allowed to say interest rates, right? But just per se, as an example, rates were 6.875, and the sellers, you've negotiated a 3% seller concession from the seller, right, towards a rate buy down. That's incredible. Maybe we get our rate down into 5.5, 5 7/8. where do rates really need to be for you to refinance? Back in the upper threes? Is that happening anytime soon? Doubtful. So, leverage the opportunity in today's market to potentially get seller concessions to buy down the interest rate.
And I've seen a lot of, we have an awful lot of new construction going on here in the area, and I see builders offering seller concessions just to get them into the property and move their real estate. They're offering great seller concessions for their financing opportunities there. So that's something I like to remind people of.
I would recommend sellers of just straight regular resale homes to really consider that, and agents that are listing properties to consider that, because everyone knows there's going to be some level of negotiation. The buyer's coming in, they're saying we're going to offer you this much, the seller wants the most that they can, the buyer wants to pay the least that they can, right? So immediately you have that working. But imagine if the seller, just right out of the gate, even if they said, hey, we'll list the property at $400,000, but we're going to offer, up to $15,000 towards seller concession. You could argue, well, why don't I just pay less for the home? Well, let that be the choice of the buyer.
Yeah.
Right? Because the buyer may say, you know what, I like that. I'll take it at $400,000. That $15,000 can cut my rate down by 1.25%, right? Which will save me X amount of money over time, which would be incredible. Then I don't have to worry about refinancing, because the chances of having that opportunity now that I bought the rate down for the life of the loan is super slim. I've just put myself in a great position, and I don't mind paying an extra $18 a month for $15,000 today, right, to buy down my rate. So, sellers, listing agents out there should really start looking at marketing that and talking with their sellers, because though you may say, well, they could just ask for it. That's cool. Just put it out there then. That it's available. Don't wait for someone to ask for it. Put it out there.
Yeah. And I haven't seen a lot of people offer, a lot of agents offering that, and maybe they just aren't aware of it. I don't know, but it's a great product. It's a great thing to use.
It's an incentive, right?
An incentive. So, definitely. The other day, I had someone ask me about a condotel and what is a condotel, and what kind of financing opportunities do I have for condotels. Generally speaking, a condotel is somewhere located along the stretch of the ocean front, offers some kind of product or service. Maybe they have a check-in desk. Maybe they have cleaning services available. Maybe they have restaurants and other services on the property. Things like that. It's really important if you're looking to make a purchase somewhere along the waterfront, something that may be considered a condotel. You need to talk with your financer to make sure that they can actually finance that.
Yeah.
That's all special financing. Generally speaking, not a conventional or an FHA loan. We're looking at either a cash buyer or special financing. Do you offer any types of financing, or can you tell me about that? What kind of financing?
Yeah, so we do. So that's an investor loan, right? And condotels, it's the characteristics, right, of the building, generally speaking. A front desk is number one, right? If you can walk in as someone that's going to rent there and you can get your keys right there and go to your room, that's a condotel. A tel, instead of hotel, condotel, it operates like a hotel. Right, central key system, central phone systems, concierge service, maid service, some of the red flags, having restaurants and stuff like that on the premises. That doesn't necessarily make it a condotel, but if you start adding that up with all the other things, next thing you know, it's like being at a Marriott.
Yeah,
right?
It's a red flag. It's something you need to look at.
Right, you need to look at.
Classify it properly.
Yeah, blackout dates where the HOA restricts you from occupying your own unit that you own on specific holidays or dates where they mandate it to be rented. Right, that's a challenge. Lockout rooms. That's a challenge. So, but there are oceanfront condos that are not condotels, right? As well. We do both. Condotels, generally speaking, 30% down. The interest rate's going to be a little bit higher. I mean, it's not significantly higher than where you'd be buying a second home, conventional or investment property from an interest rate standpoint. They're all investor loans, and there's a couple of restrictions in regard to size. It's got to be one full bedroom. It can't be an efficiency. But again, we're the filter.
One other type of financing we haven't talked about is adjustable rate loans. Let's talk about that real quick.
Yeah, and probably a good reason, right? So not to get too deep into the economy and, kind of what's happening there, but, we're in what's called an inverted yield curve. So your short-term yields are actually higher than your long-term yields. Usually it's the other way around, right? And that's where you generally get a lot of good play from adjustable rate mortgages, whether it's a 3-year fixed program based on the 30-year amortization or a 5-year fixed interest rate based on the 30-year amortization. Usually they would be significantly better than a 30-year fixed. But it's weird because they're just never like big into play. That's like, it's very specific to someone that is, I am not carrying this note for 2 years. I'm not carrying this note for 3 years. I don't mind the adjustable. Most people, when they hear adjustable, they're running, right? And I don't, even folks that say, hey, I'm only carrying this for 3 years, to me, it's like, well, for the difference, right, depending on what that spread is between a 30-year fixed and adjustable, for the difference, I'd rather just have the insurance that I don't have to, God forbid, some life-changing event occurs and I'm not paying off that mortgage or I'm not selling that home in that amount of time. Now I'm carrying it. Now I'm in an adjustable rate mortgage environment, right? The fixed term is over. Now it's adjusting. So I'm more of a fixed guy across the board, just for, call it insurance purposes. God forbid something happens that my plans have changed. But in this environment, there's just really no play for adjustable rate mortgages in an inverted yield curve. There was a moment where, and it even exists now in most areas, where the adjustable rates are actually higher than the 30-year fixed is in some cases. You're starting to see that come down a little bit, but even if it were off by, even if an adjustable rate was better by 0.125 in interest rate, would you really do that over a 30-year fixed?
Well, how about with a 30-year fixed and using points to buy down your mortgage rate? How does that work?
Yeah, if there's any time to buy points down, this is the time. And I say that, again, depending, how long do I plan on being in the home? How long do I plan on carrying the mortgage, right? There's a lot of little things that go into that equation of whether it makes sense or not. And those are things that I talk to my clients about all the time. I call it the break even. When do we break even, right? In the past, you may know that formula, you pay a point, your rate goes down by 0.25%. That was generally the formula, right? Pay 1 point, my rate's better by 0.25%. Well, on average, when you do that math, it's usually, average loan size maybe $280,000, $300,000. It's usually a 4 to 5 year, if not longer, break even. So that's why points weren't so attractive, because you'd be like, okay, well, I'm going to pay $3,000 today to save $24 every single month, but it's going to take me 5 years just for that to make sense, right? Well, based on where everything is at today, right? We're in a higher rate environment, right? We also have risk and volatility being built in by, let's just call it Wall Street, just to make the world easy, right? These investors, servicers, et cetera, right? What they don't want is they don't want a high interest rate to be delivered. Why? Because the servicer is banking on carrying that note for 5 to 7 years, right? That's what they're banking on carrying that note for it to make sense for them to service that note. If you were, and this is why we had even primary residence where you couldn't get a rate without paying points, right? Because they could not give a high enough par rate with no points that would have any level of marketability out in the secondary market. No one's buying a rate at 8% out in Wall Street. Why? Because where the rates need to go for them to refinance, right? So if the consensus is rates are going to be maybe somewhere in the mid-5s, upper 5s through 2024, and they're giving par pricing but no points at 8%, no one's buying that note out in Wall Street because the chances of that note lasting more than a year is slim to none. So the servicing company's making no money. In fact, it's costing them money because they're paying for it, I'll pay you this, you give me that, right? We're going to service it for 5 to 7 years. We're going to make X amount of money. You made your money. Everyone's good, right? Well, if there's no money to be made because the rate's so high, because the consensus is that that thing's going to refinance within 12 months, there's no market for it. So what you're seeing from a point standpoint, no pun intended, is rates have a cap. They have a cap. Maybe that cap is 7.5%. Maybe it's 7.25%. Like that's the highest rate. Maybe 7 5/8. That's the highest that you can get. And even at that, it's costing points. But what you'll find out is, let's just say as an example, second home buyer, putting down 25% on a vacation home, and the rate is 7.25%, and it's going to cost you, 1.5 points. I'm just putting that out there, right? But you can get down to 6.625 or 6.5 for 2.5 points. So for 1 point more, you can be buying your rate down anywhere from 0.5% to 1 full percent more for 1 point. That's dollar for dollar, where in the past it's 1 point equals 0.25%. So your break-even points now are anywhere from 1 to 2 years. Versus 4 to 6 years. So, I say to people, and then you're not worried about, am I refinancing later, right? Because you've done a life-alone buy-down is what I call it. And now if I'm at 6.5, rates need to be at 4.5, right? Generally speaking, right? To make sense for me to refinance, there's a chance that's not going to happen, right? Anytime soon. So I always tell folks, if you have the wherewithal, buy down whatever you can legally buy down to in this environment right here. And or get the seller concession, right, to help buy down. Do a life-alone buy down as much as you can.
Definitely something that everyone
based on everyone's individual situation. Someone may be like, hey, I'm buying it now, but I'm selling my home up north next year and I'm paying this thing off. Okay, if that's the case, take the highest rate that we can get with the least amount of points, right, and pay it off in 12 months. So every story is different, every scenario is different, but those are a couple of different ways of looking at it.
Ed, this has been such great information today, and I think everyone listening to this conversation will really appreciate it. You're so knowledgeable, and we're in a great market here in the Myrtle Beach area. I really do appreciate you taking the time to come in and speak with us. I feel like we could sit here and talk for hours more.
We could. I need a few more sips of water, but I think I can make it.
Well, we'll do it again.
Well, I really appreciate the opportunity, and as always, appreciate your partnership and everything that you do. So thank you. Your clients are certainly super lucky to have you.
Oh, well, thank you so much.
So.
Thank you so much. I appreciate it.
Well, thank you.